Welcome to the deep dive. Today we're doing something a bit different. We're not just looking at a success story, but maybe something even more valuable. We're digging into the learning journey of Warren Buffett, the Oracle of Omaha, the legend behind Berkshire Hathaway's amazing run.
Exactly. We all know the huge wins, but it's his mistakes, the ones he actually talks about, that offer, well, a goldmine of practical wisdom.
Totally. And his willingness to just put them out there, that's pretty rare.
It really is. It lets us peek behind the curtain, see that even the absolute best learn through trial and, error. This isn't about criticism. It's about finding actionable insights for anyone, really, who's trying to navigate the business world.
Right. So our mission for this deep dive is to unpack, I think we've picked 7 key mistakes or maybe periods of mistakes that Buffett himself has pointed out. We're not just recounting history here. We want to look for the signs, maybe the early warnings he missed.
And the benefits of learning from it afterwards. How these lessons apply to, say, entrepreneurs today.
Yeah, and the competitive landscape at the time, what that tells us. And the big takeaways for you listening.
Okay, let's do it.
Let's get right to it. Starting at the beginning, really. The original Berkshire Hathaway, the textile business. This first big buy, the one that gave the company its name, Buffett famously called it the dumbest stock I ever bought.
He did. And a significant blunder.
Yeah.
His initial plan, the smart plan, was actually to sell his Berkshire shares and use that money to get into insurance.
Yeah.
Totally different field.
A much better field in hindsight.
Absolutely. But then, the story goes, there was a dispute over the sale price for his shares. And it triggered this, well, surprisingly emotional reaction from him.
So instead of sticking to the plan.
He just bought more stock compulsively. Ended up taking control of this, frankly, failing textile company.
Wow, it really makes you think, doesn't it? How often does a little bit of frustration just derail a solid strategy?
It's a huge reminder. So looking back, what were the signals, the signs that buying a textile mill, especially when insurance was the goal, wasn't the best path?
Yeah, what were the red flags?
Well, the biggest one, pretty obvious maybe, was the state of the textile industry itself. It was already heading downhill, facing huge challenges.
Okay.
Second, the decision to buy more, to take control. It came straight from that emotional spat during the negotiation. It wasn't based on, a fresh look at the business's future.
The reaction.
Pretty much. And third, it was just a sharp turn away from his stated goal insurance. Shows how easily even someone like Buffett can get swayed in the moment.
Okay, so let's unpack this then. Even though it was a blunder, what good came out of it? What did Buffett, and maybe we as entrepreneurs, learn from that early mess up?
Well, it hammered home the absolute need for disciplined decision-making. Logic and analysis over emotion, especially when things get tense, like in a negotiation.
Right.
It also really highlighted how crucial it is to understand the basic economics of any business you're in. Is this industry growing or shrinking? What are the real fundamentals?
And focusing on strength, not weakness.
Exactly. The value of putting your energy into businesses with strong prospects, rather than trying to, turn around something that's fundamentally struggling. Sometimes you just need fertile ground.
So for an entrepreneur listening right now, maybe they're feeling that emotional pull in a deal or thinking about pouring more into a struggling project. What practical steps can they take from this?
Okay, first, actively try to cultivate emotional detachment. Use data. Use logic. Checklists can actually help under stress.
Checklist, interesting.
Yeah, or having a trusted advisor, someone to bounce things off to keep you grounded. Then, really rigorously analyze the core business model yours or a potential investment. Are the fundamentals solid?
And stay focused.
Definitely. Define your main strategic goals clearly. And don't get sidetracked by things that, look appealing short-term or you feel attached to but don't really fit the plan.
Makes sense. Who were the competitors back then? Just to get the context.
Well, directly it was other textile companies, all facing similar headwinds. Broadly speaking, any company in a declining industry was in the same boat. But maybe the big competitor was the opportunity cost.
Ah, the insurance companies.
Exactly. The ones he planned to invest in. That was the potentially much better path he didn't take right away because of this detour.
So summing up the lessons from this dumbest stock buy for entrepreneurs.
1, don't let emotions drive your big business or investment calls. 2, really understand the intrinsic value, the real worth, and the future prospects. Dig deep.
And 3,
sometimes the smartest move is just admitting it's not working and cutting your losses. Preserve your capital, your energy for better opportunities.
that's a tough one, cutting losses, but vital. Okay, let's jump forward. Another big acquisition mistake Buffett himself highlighted, Dexter's shoe. He called this one gruesome.
Yeah, 1993. Berkshire bought Dexter's shoe for about $433 million. And the crucial part, paid entirely in Berkshire stock.
Ouch, knowing what Berkshire stock did later.
Exactly. He called it his worst deal, his most gruesome, mainly because he really overestimated how strong Dexter's competitive edge was. Its moat.
He thought they had this durable advantage, like brand or cost structure.
Right. He thought it was strong, defensible, but he seriously underestimated the threat from cheaper foreign competition. That basically just eroded Dexter's position over time.
So what were the signs this time, the red flags that maybe Dexter wasn't as solid as it looked?
Well, the main one was that overestimation of the moat and just not fully seeing the storm coming from overseas competitors with lower costs. That was number one.
Okay.
Secondly, paying with Berkshire stock. That turned out to be incredibly expensive down the road as Berkshire's value just kept soaring. It made the effective purchase price huge.
A massive amplifier of the mistake.
Absolutely. And third, Buffett himself reflected later that maybe he was a bit too eager to put Berkshire's cash to work. Maybe didn't wait patiently for an even better pitch.
Okay, let's dig into the learning here, especially about using valuable company stock for deals. What came out of this painful lesson?
It definitely instilled a much stronger discipline about using Berkshire stock for acquisitions, like only for truly exceptional slam dunk deals.
Reserve that currency.
Exactly. It also hammered home just how vital it is to do a super thorough, realistic assessment of competitive advantage. Was that moat really deep and wide enough to last against all threats?
Don't fall in love with the moat story.
Right, and it just reinforced the virtue of patience, selectivity. Don't feel you have to swing just because cash is piling up. Wait for the fat pitch, as he'd say.
How can entrepreneurs apply that, whether they're buying companies or just trying to build their own competitive edge?
Well, when you look at your own market, do a really deep, ongoing analysis of threats. Not just your current rivals, but where could disruption come from? Overseas, new tech. Be paranoid.
Good
Healthy paranoia, yeah. And if you are acquiring, be disciplined on valuation. Don't overpay, even if it looks shiny. Be patient.
And the cost of capital.
Understand the true cost of whatever you're using cash, your own stock, debt. Think about the long-term implications, especially if you're using equity that could appreciate.
Who are the competitors around Dexter that really highlight this mistake about their moat?
Obvious ones were other shoe companies, domestic and global. But specifically, those companies churning out cheap imports, say from China, they were the force that really undercut Dexter.
Right.
And maybe broadly, other conglomerates making deals at the time. You can compare, did they overpay? What happened later? It provides context.
So the key lessons from the gruesome Dexter deal for entrepreneurs.
1. Competitive advantages can vanish way faster than you think. Markets change, disruption happens. Stay alert.
Ew.
Paying with your own appreciating stock can make a bad deal truly disastrous. It magnifies the error enormously over time.
And 3.
Patience. Waiting for the truly great opportunity, not just a good one, is fundamental. Don't rush into deals.
Very valuable reminders, especially today with markets moving so fast. Okay, let's shift now. Let's look at a different kind of misstep. Not the initial buy, but holding on too long. The Tesco situation.
Right, the UK retailer. Buffett invested, but then in 2014, he admitted making a big mistake by dawdling, basically holding the stock too long as things went south.
And this brought up issues with management and reacting to market shifts.
Exactly. It seemed like there were problems with management credibility, maybe effectiveness, combined with Tesco just not adapting fast enough to how retail was changing. Online competition, different consumer habits.
It really highlights how crucial leadership and adaptability are.
Absolutely. You have to keep evaluating that.
So what were the signs there? The things Buffett maybe didn't react to quickly enough with Tesco?
Well, he didn't spell it all out, but his comments about management integrity being vital, that strongly suggests there were probably warning signs about maybe misleading practices or ethical issues at the top. Secondly, you could see the momentum shifting. Online retailers, other disruptors were clearly gaining ground. That was a big flashing light for traditional players like Tesco.
And the admission itself.
Yeah, Buffett admitting he dawdled, held on too long while the value dropped. That's the ultimate sign, right? He knew he'd stayed too long.
So what are the benefits of learning from that? Holding on too long when things are going wrong?
Well, it definitely seemed to increase his scrutiny of management teams, their credibility, their competence, how adaptable they are.
Makes sense.
It also just powerfully underlines how important it is to constantly watch the market, watch the competition, see how customer behavior is changing. Don't get complacent.
And the discipline to sell.
Crucial. It reinforced the need to have the discipline to cut your losses, to exit when your original reason for investing just isn't true anymore, even if it means admitting you were wrong.
How can entrepreneurs apply that vigilance, that decisiveness?
When you're picking partners or leaders, do serious due diligence. Not just skills, but integrity, ethics. That's huge. Keep scanning your market constantly. What trends, what tech, what competitors could shake things up? Don't get tunnel vision.
And have an exit plan.
Yes. Have clear metrics, clear trigger points for investments or business lines that are underperforming. And be ready to actually act when those points are hit. Don't let hope cloud the data.
Who are the competitors that maybe should have prompted a faster reaction regarding Tesco?
Well, you had the other big global grocery chains, the usual suspects. But the real pressure was coming from the online guys, the e-commerce players who were just reshaping the whole landscape.
You were changing the game.
Totally. And maybe, other investors who also got stuck holding on to struggling retail stocks too long. They serve as a cautionary tale about inertia.
So, key entrepreneurial lessons from Tesco and the cost of dawdling.
First, management integrity is absolutely foundational, non-negotiable. Second, even if you're dominant today, that's not permanent. You have to stay agile, adapt, innovate.
And finally,
know when to fold them, learn when to admit a mistake, investment, strategy, whatever, and cut your losses quickly. Delaying just makes it worse.
important points. Vigilance, decisive action.
Okay, let's move to a different kind of mistake, trying to predict commodity prices. The ConocoPhillips investment.
Yeah, this is back in 2008, right before oil prices peaked and then, well, crashed. Buffett made a big bet on ConocoPhillips.
And when the market turned.
Berkshire took some significant losses. Buffett himself called it terrible timing.
So the bet was basically that high oil prices would just keep going up.
Largely, yes. The investment seemed based on the idea that those high prices were sustainable. But then the global financial crisis hit, other factors kicked in, and oil prices just plummeted, took ConocoPhillips down with them. What were the signs beforehand that betting heavily on sustained high oil prices might be, risky?
Well, the main sign is just the nature of the bet itself. Making a huge investment based on predicting commodity prices, that's notoriously difficult, volatile. Second, the timing, in hindsight, was clearly near the peak of that oil cycle in 2008. That's a classic warning sign.
And Buffett admitted it.
Yep, his own admission of terrible timing really confirms the flawed premise. He knew he'd mistimed it badly.
What are the learning benefits from this experience, trying to time those wild commodity swings?
It really drove home just how hard and how risky it is to try and time commodity markets or make big bets based purely on short-term economic forecasts.
Focus on the business itself.
Exactly. It highlighted the importance of focusing on the intrinsic value of the company's underlying worth, its long-term prospects, rather than getting swept up in commodity price swings or market sentiment.
And caution with commodity-linked companies.
Yeah, it encouraged maybe a more cautious, perhaps more diversified approach to companies whose fortunes are really tied to the roller coaster of commodity prices.
How can entrepreneurs apply that, the danger of market timing?
Base your core decisions, your long-term strategies, on the fundamental value of the business itself, not on guessing where oil prices or interest rates are going next week.
Manage the external risks.
Be aware of them, yes. Understand how things like commodity prices or economic shifts could impact you, and have plans to manage that exposure.
Yeah.
Contingency planning.
And avoid chasing trends.
Be really careful about investing or launching something just because its price has been going up fast. Look for the real underlying value. Understand the downside risks. Don't just follow the herd.
Who are the competitors or examples around ConocoPhillips that illustrate this commodity risk?
Well, other big oil and gas companies, obviously.
Yeah.
Many of them rode the same roller coaster.
Sure.
More broadly, any company whose profits swing wildly with commodity prices faced similar issues. And, other investors who tried to call the top of the oil market in '08 and got burned. Lots of company there.
So the essential lessons for entrepreneurs from ConocoPhillips and market timing.
1. Trying to predict short-term commodity or macro moves is super risky. Don't base your core strategy on it. 2. Real, lasting value comes from strong businesses, solid fundamentals, not just favorable market wins.
And beware momentum.
Yeah. Be careful with momentum investing. Always look for genuine undervaluation and understand the risks involved. Don't just chase rising prices.
Good advice, especially with volatile markets. Okay, let's switch gears again. A different kind of mistake, the mistake of not doing something. The cost of omission, missing the early tech giants.
Right. This is one Buffett's been very open about, not investing early in game changers like Amazon and Google.
He even said he's too dumb to realize Bezos's potential.
Something like that, yeah. It's incredibly candid, and it really shows the challenge, even for someone like him, of adapting to industries that are changing fast and look complex from the outside.
His traditional approach favored businesses he could easily understand, right?
Yeah.
Tangible assets, long track records.
Exactly. That philosophy served him incredibly well for decades, but it understandably led to some hesitation, maybe skepticism about the tech sector during its really explosive early growth. It looked different, less predictable maybe.
So what were the signs back then, even early on, that companies like Amazon and Google were truly different, truly transformative, signs that maybe a traditional lens missed?
Well, one big sign was just how innovative their business models were. They were fundamentally disrupting huge established industries. That was clear.
Right.
Another was their ability to scale incredibly quickly, just grabbing massive market share in ways nobody had really seen before.
And the leadership.
That was key too. Visionary leaders like Bezos, the Google founders, they weren't just talking about small improvements. They had these huge long-term visions and they were executing on them. That combination is powerful.
Okay, so what were the benefits of eventually recognizing this mistake of omission, even if the big investments came later?
Well, the most obvious benefit was the shift in thinking that led to those later, very successful investments in tech, especially Apple. That was huge.
A major evolution.
Absolutely. It also powerfully emphasized how crucial continuous learning is. Staying curious, being willing to grapple with new industries, new models, even if they're outside your comfort zone.
Don't just dismiss what you don't immediately get.
Exactly. That's the danger. Dismissing something just because you don't initially understand it or it doesn't fit your old framework, that can be incredibly costly.
How can entrepreneurs avoid making similar mistakes of omission, missing the next big thing in their field?
Make learning a habit. Actively seek out information about new tech, new models, shifting customer needs. Make it part of your routine.
Stay open-minded.
Cultivate that, yeah.
Yeah.
Explore opportunities that seem unconventional or outside your immediate expertise. Don't shut doors too quickly.
And look at execution.
Yes.
Yes.
When you see potential disruptors, look closely at the leadership. Do they have the vision and the ability to actually make it happen? Execution is everything. Don't just evaluate the idea, evaluate the team.
Who are some of the other tech players that really underscore how big this missed opportunity was?
Well, beyond Amazon and Google, you had Microsoft continuing its dominance, later Meta. The sheer value created in tech was just astronomical.
Right.
If you compare Berkshire's performance during that specific period to funds or investors who did embrace tech earlier, the difference is stark. It really highlights the cost of omission.
So the critical lessons for entrepreneurs from missing the early tech wave.
Intellectual curiosity, lifelong learning. They're not optional, they're vital for staying relevant and spotting opportunities. 2, don't underestimate disruptive tech or visionary leaders, even if their ideas seem wild at first.
And the cost of inaction.
Remember that errors of omission, the things you don't do, can be just as damaging, maybe even more so than errors of commission, the bad decisions you actively make. Sometimes not acting is the biggest mistake.
That's a powerful thought. Sometimes the biggest risks are the ones you don't see or don't take. Okay, let's turn to an industry Buffett kept coming back to, often with painful results. Airlines.
Ah, yes, the airline industry. A notoriously tough business. Buffett has invested multiple times over the decades, often getting out later, sometimes with losses.
And he's basically said it took him several tries to really learn this lesson, right? Including the big exit during COVID.
Exactly. He's been quite candid about needing multiple mistakes to finally get the message about airlines. It's just a fundamentally challenging industry.
Why is it so tough?
Well, it's incredibly capital intensive. Think of the cost of planes. Huge ongoing investment needed. High fixed costs. Then you've got brutal competition, often driving prices down.
Makes sustained profits hard.
Very hard. Plus, it's super sensitive to external shocks, economic downturns, fuel price spikes, geopolitical issues, pandemics. Lots of things can knock it off course.
So looking at these repeated attempts, what were the consistent warning signs about airlines that maybe should have waved him off sooner?
Well, the basic structure, the capital intensity, the constant need to reinvest just to stay competitive, that was always there. That's a fundamental challenge. The industry's extreme vulnerability to external events, Things completely outside its control, that was another recurring red flag.
Yeah.
You just knew something could always come along and disrupt things badly.
And his own track record.
Yeah, his own history of getting in then getting out, it suggests a real difficulty in finding a lasting competitive edge in that specific sector.
It just kept proving tough.
What were the hard-won benefits from these repeated, sometimes costly airline lessons?
It really solidified that core principle. Be extremely wary of industries with historically bad economics, especially ones that just eat capital constantly.
Right.
It also really highlighted the need to react fast when the whole outlook for an industry changes fundamentally and negatively, like with COVID. Don't wait and hope.
Understand the external risks better.
Absolutely.
Yeah.
It stressed how vital it is to really understand and factor in those external risks that are specific to certain industries. How vulnerable is this business to things it can't control?
How can entrepreneurs apply that? Thinking about tough industry structures. Do a really honest, hard look at the economics and risks of your own industry, or one you're thinking of entering. Be brutal.
Plan for shocks.
Develop serious scenario plans. What happens if X, Y, or Z occurs? How would it impact you? What are your contingency plans? Be prepared.
And be ready to pivot.
Be ready to change course quickly, cut losses if needed, when the basic assumptions about your industry turn out wrong or the landscape just shifts dramatically. Agility is key.
Who are the competitors or examples in the airline world that really show these challenges?
Well, pretty much all the other major airlines.
Yeah.
Many have struggled with profitability, gone through bankruptcy, restructured. It's a long history of difficulty across the board.
Sure.
Other travel and transport companies share some of those sensitivities too. And of course, other investors who kept betting on airlines and got burned. Plenty of cautionary tales there.
So the core entrepreneurial lessons from Buffett's airline adventures.
One, some industries just have built-in structural problems that make consistent profits incredibly hard, no matter how good management is.
Yeah.
Recognize that. When things change drastically for the worse, admit the mistake fast and act decisively. Cut losses. Don't hang on hoping things magically return to normal.
And learn from repetition.
Yeah. Past mistakes, especially repeated costly ones, should be powerful teachers. They need to strongly inform your future decisions so you don't make the same flawed assumptions again.
A clear case of learning the hard way, perhaps multiple times. Okay, for our final mistake deep dive, let's look at the Pacificor acquisition. This one's about structure.
All right, the utility company acquired back in 2005. The mistake Buffett later identified wasn't the purchase itself, but how it was structured initially.
They didn't break it up by state, kept it aggregated.
Exactly. They kept its operational structure unified across the several Western states it operated in. And that decision, maintaining that aggregated structure, led to some massive liabilities later on, especially from wildfires.
Why keep it aggregated initially? What was the thinking?
Likely the perceived benefits of scale, operational efficiencies across the whole system. That was probably the rationale.
But the different states were different.
Very different. Different regulations, different legal environments, different risk profiles, like wildfire risk, for example. Trying to manage that complexity under one single structure created huge problems down the road. Problems that might have been contained or managed differently if it were structured by state.
So what were the signs back in 2005 that this aggregated structure might cause trouble later?
Well, the simple fact that it operated in 7 different states, each with its own rules and risks, that alone should have triggered a really deep dive into the best structure. That complexity was a sign.
Okay.
The deliberate decision not to restructure along state lines, despite those obvious differences in risk and regulation, that was the critical choice, the oversight.
And the proof came later.
Yeah, when these huge liabilities emerged, often concentrated in specific states due to things like wildfires, it became clear how that initial structural choice had created or amplified the problem. The link was direct.
What are the learning benefits from this kind of mistake? Getting the initial deal structure wrong.
It really drove home how vital it is to meticulously analyze and optimize the structure, legal, operational, financial, of any acquisition, especially complex ones operating in multiple places.
Increased awareness of regional risks.
Definitely. A much greater awareness that risks can be very different in different regions, even for the same company. You need tailored risk management.
And the power of the initial setup.
It just underscored the huge, often permanent impact of those initial structuring decisions. Get it right, and you mitigate future problems. Get it wrong, and you might be baking in liabilities for years to come.
How can entrepreneurs apply these lessons, these maybe less glamorous structural points?
When you're doing a deal, expanding, or even just setting up your own company, think hard about the optimal structure to minimize future risks. Don't just default to the simplest option.
Understand the rules everywhere.
Deeply understand the regulations, the legal quirks, the specific risks in every single place you operate or plan to operate. That knowledge is crucial for structuring correctly.
And due diligence needs to cover structure.
Absolutely. Your due diligence has to go way beyond just the financials. It needs to deeply examine the legal and operational structures for hidden vulnerabilities, potential liabilities baked into the way it's set up.
Who are the competitors or examples that highlight why this structural stuff matters so much?
Other big multi-state utilities face exactly these kinds of challenges. They're good comparisons.
Right.
Also, businesses in other highly regulated fields like finance or healthcare, where operating across different jurisdictions brings huge structural complexity.
And deal makers.
Yeah, investment firms that regularly buy complex multi-jurisdictional assets, looking at how they approach structure and risk mitigation can be really insightful.
Okay, so the critical entrepreneurial lessons from the Pacific Core structural mistake.
1. The initial structure of your deal, or your company, has massive long-term consequences for risk and liability. Pay close attention up front. 2. Complex regulations across different places demand really careful navigation and smart structuring. Don't underestimate this.
And thorough analysis
Includes a deep dive into the legal and operational structures. It's not just about the numbers on the spreadsheet. How is this thing actually put together? That's critical.
a really important reminder. The nuts and bolts of the deal, the structure, can be just as critical as the flashy parts. So there we have it. 7 different moments, 7 insightful examples where Warren Buffett himself has acknowledged making significant mistakes. We had the initial Berkshire textile blunder,
The Dexter shoe overestimation,
sold in Tesco too long,
the ConocoPhillips market timing issue,
missing the early tech giants, the cost of omission,
the repeated struggles with the airline industry.
and finally, that Pacific Core structural oversight.
And really, the big takeaway, the invaluable lesson here, isn't just that even the best make mistakes.
Yeah.
Know that. Is how Buffett responds. His success is so tied to his willingness to just admit the errors openly, then rigorously figure out what went wrong. And crucially, apply those lessons going forward. That's the magic.
Absolutely. It speaks volumes about humility, about patience, about committing to always be learning, always evolving your thinking, and sticking to core principles refined over decades of experience, both the wins and the losses. These aren't just investing tips, they're fundamental business principles.
Totally. By really studying these specific missteps from one of the greats,
Yeah.
entrepreneurs like you listening can gain some incredibly valuable perspective, maybe navigate your own journey with a bit more wisdom or foresight, and potentially sidestep some of those common, costly pitfalls yourself.
So as you think about this deep dive, maybe consider doing your own mistake inventory. Could be powerful, individually or with your team. Look back at past errors, investments, strategy calls, operations, maybe even hiring decisions. And apply this framework we talked about. What were the early signs you missed? What did you really learn from it? How can you apply that lesson now? Who are the competitors in that situation, giving context? And what's the core sticky lesson to carry forward?
Yeah, that process of honest reflection. You can turn those setbacks from something you regret into a really valuable roadmap for doing much better next time.
It's about intentionally using past failures as data points, building a more informed, more strategic, and ultimately, a more resilient approach for whatever comes next. Welcome to the deep dive. Today, we're doing something a bit different. We're not just looking at a success story, but maybe something even more valuable. We're digging into the learning journey of Warren Buffett, the Oracle of Omaha, the legend behind Berkshire Hathaway's amazing run.
Exactly. We all know the huge wins, but it's his mistakes, the ones he actually talks about, that offer, well, a goldmine of practical wisdom.
Totally. And his willingness to just put them out there, that's pretty rare.
It really is. It lets us peek behind the curtain, see that even the absolute best learn through trial and, error. This isn't about criticism. It's about finding actionable insights for anyone, really, who's trying to navigate the business world.
Right. So our mission for this deep dive is to unpack, I think we've picked 7 key mistakes or maybe periods of mistakes that Buffett himself has pointed out. We're not just recounting history here. We want to look for the signs, maybe the early warnings he missed.
And the benefits of learning from it afterwards. How these lessons apply to, say, entrepreneurs today.
Yeah, and the competitive landscape at the time, what that tells us, and the big takeaways for you listening.
Okay, let's do it.
Let's get right to it. Starting at the beginning, really. The original Berkshire Hathaway, the textile business. This first big buy, the one that gave the company its name, Buffett famously called it the dumbest stock I ever bought.
He did. And a significant blunder.
Yeah.
His initial plan, the smart plan, was actually to sell his Berkshire shares and use that money to get into insurance.
Yeah.
Totally different field.
A much better field in hindsight.
Absolutely. But then, the story goes, there was a dispute over the sale price for his shares. And it triggered this, well, surprisingly emotional reaction from him.
So instead of sticking to the plan.
He just bought more stock
Yeah,
compulsively. Ended up taking control of this, frankly, failing textile company.
Wow, it really